So, in continuation with the discussion on the off balance sheet items of the commercial bank, in the previous class we discussed about certain instruments like your derivatives instruments, we have the loan commitments, note issuing facility and all kinds of things. Today, we can extend our discussion to some other off balance sheet items what always commercial banks use for their banking activity. So, those items include the loan sales, trade finance, we have the foreign exchange business what the commercial banks always do. Then we have the services, whatever the other services the commercial banks provide and against that they charge some fee. Then we have the investment banking, which is also different from the commercial banking, but commercial banks also provide certain investment banking services at the time of requirements, and they have also the selling the investment products. So, these are the different other kind of services or other kind of balance sheet items which exist with the commercial banks. We can see that how those kind of things are defined and how those things are really helpful for the banks to generate certain kind of revenue, which has the larger implications from the total profitability of the commercial bank. So, here whenever we talk about the loan sales, what it exactly means, the bank can sell their loans to a third party as a source of the fund. Normally, what happened that this is mostly purchased by the large banks and the non-financial institutions. If a smaller bank has provided a larger loan, a big loan, then that loan can be sold to another bank and the particular bank can share the credit risk what the small bank has already have. So, in this context, the larger banks can share the credit risk with the smaller bank and the smaller bank in that process is selling that loan to the larger bank. So, it is basically sharing the credit exposure between the different type of banks which are existing in the system. So, the loan sales is always made to get rid of the credit risk in the system, and even though the loan sold by assignment, if the loan sold by assignment, that is the buyer holds the loan, the selling bank retains some credit risk in whole or in part for the loan losses. Because it is shared between the two different parties, so whoever has the initiator of that particular loan, they also share some credit risk, and the particular bank who has bought that particular loan from this another commercial bank who has initiated that loan, they also share some credit risk. Because now the loan is shared between the two different entities and the two different entities basically has always exposed to certain kind of loan losses. So, if there is a probability of loan losses, then obviously, they are also exposed to some amount of credit risk in the system. But there are certain benefits what we can receive whenever we provide this kind of or we involve in the activities like the loan sales. What are those type of benefits what we can get? It enables the bank to increase the diversification. First of all, the bank who is buying this particular loans, they are able to diversify their loan business in the system, or they have the kind of excess surplus they whatever they have, and that particular money also can be utilized in the market in a proper way. It also helps in terms of lower capital requirements, because the amount of money which is required, that basically is already materialized in the market. So, because of that the capital requirements accordingly is changed, and the commercial banks can enjoy that particular benefits from this, and it eliminate the low earning assets from their portfolio. That is also another advantage we can get, and the particular bank who has shared that particular loan, they are also able to reduce some amount of credit risk. So, one is major thing is it is increasing the diversification, that way they are able to minimize the risk, and it is also helping to reduce the credit risk, because the smaller banks may not be compatible or may not be well enough to bear that amount of credit risk in the market whenever they have given a larger loan to the customer. So, this is the way the loan sales work, but there are some demerits. the bank would sell off the high quality, high marketable loans and eventually end up with lower quality loans on the balance sheet. So, if the particular loan is doing well, but still because of certain reasons the bank has gone for loan selling, then the bank can incur certain kind of losses if they will go for a low quality loans after that. So, in that process, to fulfill the requirement of the customer, they can go for the loan selling, because they do not have enough cash available with them. But in that particular process, sometimes also they have chosen a certain kind of customer or the loan seeker who is basically is not in that quality loan seeker, or the probability of default against that particular loan seeker is relatively higher. So, in that case they are exposed to more credit risk in comparison to the risk whatever they have in the future whenever the larger loans was involved with respect to that bank. So, if you talk about the implications of the loan selling, there are many implications what we can get, that make the loans relying on deposit as a source of the funds. That means, without deposits also the commercial bank can provide the loan in the process of the loan selling, that is number one. It convert the traditional lending into quasi securities business. In terms of direct lending activities, they can have the lending activities where the credit exposure is relatively less, and as well as the credit risk of that particular bank also will be relatively less. By purchasing the loan sales, other non-banking financial institutions are becoming like banks, or they provide certain kind of behavior what exactly the banks are providing whenever they are involved in kind of loan business. So, these are the different implications what we can draw whenever the loan selling takes place by a commercial bank because of certain reasons. Then another one is your acceptance participation, that is also another instrument the bank use as an off balance sheet items. So, a banker's acceptance is created when the bank accepts a time draft, basically a bill of exchange, and agrees to pay it at face value on the maturity. In the previous class, we were discussing about the letter of credit. In that process also, it the more or less synonymous to that process, that whenever we are using that particular instrument as a balance sheet item, the bank is basically accepts a draft, time draft, which is nothing but a bill of exchange, and they are agreed to pay at the face value at the maturity if under certain terms and conditions. And this particular draft basically covers the sale of goods with respect to the international trade, and the banker's acceptance is booked as an asset. It is considered, banker's acceptance can be considered as an asset by the entities who are basically dealing with this kind of business. Some banks can sell the participation certificate for all or part of the time draft. Whenever they are able to, or they are selling this kind of participation certificate to the different other entity, then they can reduce the dollar amount shown in the books, number one. It will have a tangible impact on the balance sheet of that particular commercial bank. Then also they are accepting the banks still obliged to pay the face amount of acceptance at the maturity. So, this is what basically the characteristics, and banks which buy this and acceptance participation have the contingent liabilities, and that do not appear on their balance sheet. So, the acceptance certificate is also again a kind of contingent liabilities what the banks have, and therefore, it is not basically shown or reflected in their balance sheet items whatever way we in actual sense we prepare the balance sheets of the commercial bank. So, the large banks operate the foreign exchange trading, another services the banks provide, that is the foreign exchange. Mostly in India, if you observe that the foreign exchange transactions are done through the commercial banks only, and we have the two segments, one is your wholesale segment, another one the retail segment. For both the segments, the banks basically play a significant role. So, in that sense, any kind of foreign exchange transactions which takes place, that is under the control of the direct central bank, which is the Reserve Bank of India, and the Reserve Bank of India basically do this foreign exchange business through these commercial banks. So, the Reserve Bank of India provides this kind of we can say that facility to the commercial banks to carry out that. According to the instructions, the commercial banks carry out this foreign exchange business in terms of the payment of the export financing, in terms of the payment of the different kind of other trading activities which is happening. So, against that, this foreign exchange business plays a very significant role, and this is one of the major businesses what the commercial banks always operate. So, fairly it is a riskless source of bank income, because the bank basically charges certain advisory or management fees whenever they do this foreign exchange business on behalf of the different type of customers. And mostly the oil companies and other companies and who have the kind of joint venture in India with a collaboration with other companies, they basically take the help of the kind of foreign exchange transactions from the commercial bank, and against that facility bank charges certain kind of premium. So, it basically those do not involve the commitments and contingencies on assets which are listed already in the balance sheet of the commercial bank, but it has the implications on the total profit or total income what they are basically generating. So, those things include the fiduciary services, other kind of services what they provide, that is basically the trust funds and the portfolio management services. They provide services like cash management and the networking. So, these are the different services they provide, and against that also they generate certain revenue, but that is basically not reflected in the balance sheet every time, but the bank is well enough, is good enough to generate some amount of revenue out of this. Coming back to the cash management, what basically we have seen that this basically used to help the business concerns collect the remittances and use their bank balances effectively, and lock boxes are important part of the cash management system, and the post office boxes where customer remittances are sent via mail and then collected by the bankers who deposit them in a business concerns account, and bank basically receives the fees and for the collection and the processing the funds which comes under the cash management. And whenever the bank provides the portfolio management services, mostly the bank will act as a fund manager on behalf of the different type of stakeholders or the investors who exist in the market. So, against that they provide different kind of services in terms of maximizing the return with a given amount of the risk what the customer basically want, and on the basis of the customer's risk tolerance limit or the risk appetite, the particular commercial banks decide that whether what kind of portfolio management services should be given to them, whether the particular investor is aggressively wants to invest in the market, or the investor is a passive investor who wants to generate certain kind of regular income from this. So, looking at the different type of requirements from the customer side, the banks basically goes for this kind of portfolio management services to them, and accordingly they also provide the cash management services to the different firms. So, this is also another important balance sheet item the bank has. Then we have the networking or the strategic alliance. It refers to basically linkage among the different companies to exploit the comparative advantage in the production and the delivery of the product. So, the symbiotic relationship seeks to increase the customer convenience for both retail and the bank side, and it uses the different network to sell the insurance product, the data processing and the other services what the commercial banks can provide. So, all kinds of services what the bank provide, against that the bank basically charges the fee, and that fee basically is considered as a reasonably good amount of income generating sources for the commercial banks as a whole. So, this is basically another services, but the another thing is we have the another aspect of this banking is investment banking. Although it is different from the commercial banking, because commercial banking has a deposit base, and from the deposits they provide the loans, but whenever you talk about the investment banking has no deposits. So, if you see in India, we have very few specific investment bankers or investment banks which are existing, who provides exclusively the investment banking services. but in Indian context we have a kind of different kind of model what we adopt, that our banks work like a commercial bank. They consider the deposits from the customer and provide the regular banking activities like providing loans, making the investments in SLR, giving the CRR requirements and all kinds of things. But they also have an investment banking division, which division basically plays the role whenever it comes to the investment banking services what the commercial bank is supposed to provide. So, whenever the looking at the economic scenario, the business cycle and other conditions in the system, then what we can say that the commercial banks which provide this kind of investment banking services to the different customers who are existing in this particular system. So, if you take some examples, there are many investment banks across the globe. If you see, we have Morgan Stanley, you have Goldman Sachs, you have Nomura, you have the Citigroup. So, those kind of services, those kind of banks do not provide the commercial banking services, but they are basically the investment bankers. But in India, we have a typical thing that we most of the commercial banks have investment banking division who provides all kind of investment banking services to their customers. So, whenever we talk about the investment banking services, that includes the risk management, that includes the pricing of the IPOs, that includes the valuation of the mergers and acquisitions. There are many kind of functions what the investment bankers do, and they also work as the underwriter, they work as the book runner, lead manager in the IPO process, and as well as they also provide certain kind of underwriting services at the time of the IPO issuance. So, many ways the investment banking services and overall we can say that the risk management services is basically provided by the investment bankers. So, whenever we get this risk management services from any kind of entity, mostly the entities are basically the investment banking divisions or investment bankers in the system. Traditionally, if you see that the best known or the most profitable investment banking services in security is the underwriting. So, against that they charge basically high amount of money, because underwriting already you know that is a guarantee that with this particular process will have certain kind of issues, then or the particular IPO process, this particular stock or particular IPO is not going to be subscribed, then it is the role of the underwriter who is bound to buy that particular asset, and accordingly what we can say that they get certain revenue out of this in terms of the management fees. So, in the investment banking part, it is traditionally it was dominated by the underwriting services. So, this basically involves the purchase of resale of the new stocks and bonds and other financial instruments in the money and capital markets on behalf of the clients who basically need to raise new money into the system at that particular point of time. So, that is why the bank basically plays a very significant role in the context that they purchase for resale and the new stocks, bonds and all kinds of financial assets whatever we have. Those assets are basically considered whenever you go for designing this investment banking in a particular bank for a particular bank. Then the leveraged buyouts, that also happens to this investment banking concept. The leveraged buyout is nothing but it involves the acquisition of a company usually by a small group of investors, and typically they are funded by the large amount of debt whatever they have taken from a particular commercial bank. By providing this kind of services to the other different entity, the bank basically is able to provide or bank can provide certain loans to a particular bank who is basically dealing with this kind of business, and against that the bank will charge certain kind of revenue, certain kind of money for that. Recently, this many investment banks jumped into the hedge fund business. The hedge funds are different from the mutual fund and other funds which are existing in the system, and how it is different that hedge funds are more risky, and there is a high net worth individuals can only can participate, or foreign institutional investors can participate in that particular process, because the amount of transaction in that segment is quite high. So, whenever we talk about the hedge funds, they are also sometimes what happens that they can be the risk partner of that particular company on which this particular investments they are making. So, there are many ways basically the investment banking positions or investment banking services are given by the commercial bank, and both if you talk about the investment banking services and commercial banking services in terms of taking deposits, paying the money as the loan, all kind of activities are basically done through the commercial banks, apart from the investment banking services what they provide. So, recently many investment banks jumped into the hedge fund. That is true, because hedge fund is relatively risky, but the return also relatively quite high. So, the banks who have the expertise for managing the funds over a period of time, they can go for this investment banking services to generate some extra revenue. Within this framework, what we have seen that investment bankers always assist in different ways. One is they want to answer many questions to their clients. Should the clients attempt to raise new capital? If so, the how much, where, and how we go about this fundraising task. Then whenever they can consult with that bank who basically needs this kind of services from them, then whenever this particular consultation takes place, the bank basically always have certain kind of issues with respect to that. And from the banking perspective and from the customer perspective, there is a two-way conflict always may arise whenever this kind of situation will be prevalent in the market. So, in this context, we can have 3-4 questions which can be raised with respect to this. The questions are like this: should the client attempt to raise new capital? If so, how much, where, and how do we go about this fundraising task? In the sense that what basically we see that whenever the banks need new capital, they have to go for, or the clients need new capital, they have to go for any kind of issuance of the public money, and the public money can be issued only through the initial public offerings, which is the process of the pricing of the IPOs, or in short what we call it the IPOs. The initial public offerings are mostly done by the commercial banks only, because they have certain expertise with respect to that. Another question also they try to answer: should client's company enter the new market area at home or the abroad? If so, then how can we best accomplish the market expansion strategy? The bank has always right to understand that wherever how the particular company is operating and which are those places these particular operations are taking place. Accordingly, the bank can decide whether the particular type of loan should be given to them or not. Then other one is should we sell our company to the another firm? If so, what is our company worth, and how do we find the right buyers? All kinds of operations or kind of activities are done by the investment bankers, and against that they only provide the fees to the commercial banks. Other day-to-day operating activities they do not have to do. So, the basic notion of investment banking is borrow the money from the one source and provide that particular money for the different purposes to the different commercial banks which are existing in the system. So, this is the way the investment management activity works in the market. Then we have in the today's context, if you see now the America is also following this approach what the India is following in terms of the banking services, because of the after the failure of the Lehman Brothers and other kind of entities which are serving for a large number of period in the US market, which has been observed that because of certain kind of mismanagement or certain kind of unexpected calculations which were made, they have suffered a lot. In that particular point of time, they do not have any kind of own capital base. That own capital base is only the equity, but they do not have any kind of funds what the commercial bank supposed to have in terms of the deposits. But in a typical investment banker does not have that kind of deposit base, and they have to generate the revenue by the different ways, by investing the money in the market, like your mutual funds, you have stock market, you have the bond market, all kinds of options which are available in the system. So, they can use that particular thing to generate that particular revenue, instead of relying upon only on the particular issue which talks about that how the commercial banks is able to maximize the profit by using those balance sheet data. So, most common investment banking divisions, if you talk about most of the public sector banks or maybe the banks which have the largest share in the market, they provide this investment banking services in India. Then we have another kind of activity or balance sheet activity what the commercial banks do, that is basically you are selling these investment products. So, the investment products like stocks, like bonds, mutual funds, annuities and the similar financial instruments seem to offer the better returns than the many conventional deposits like fixed deposits or saving deposits and other things. Depositors also invest their money in other alternative investment options like real estate. This is basically investment in the real estate is an effort to keep up with inflation, because the valuation or the value of the real estate can increase on the basis of the demand forces in the market, demand and supply forces, obviously that will be there, and as well as also the economic conditions or the price stability of the system as a whole. That also can play a role in that particular context, that how this particular investment product is going to affect the balance sheet of the commercial banking system. In response to banks developed investment and insurance product and offered the financial planning services, that also they provide in today's context, and the most common investment product is basically the mutual funds. It is not only the mutual funds, the investment products also the banks provide, like your insurance product and as well as the other product which are existing. So, the mutual funds and other kind of products which are sold by the banks in for two ways. One is to facilitate the customers and the as well as to generate some extra revenue in terms of their fee or maybe services fee for the charge against this particular thing. So, in this context we have mutual funds, already all of you have the idea about this. So, this has been basically a kind of fund which has the common objective. It is a pool of the funds with a common objective. So, in this context this has been attractive over the periods, because it is professionally managed and the lack of financial knowledge may not hamper or may not create any kind of obstacle if anybody wanted to invest in the mutual fund. So, mutual funds have been attractive to many individual or the institutional investors because of long run yields which are appear to be relatively high, and the most funds are diversified because it is professionally managed. And the popular mutual funds which are available, there are many ways the mutual funds can be defined, but they are traded basically in the exchange traded market or exchange traded funds. And hedge funds is a type of mutual fund. It is what it is. There is a many differences in terms of mutual fund is a small savings, but the hedge funds are basically is a very large amount of investments is required if anybody wants to invest in the hedge funds. And hedge funds are less regulated, but mutual funds are highly regulated. And the hedge fund market in India is very underdeveloped, but mutual funds is quite popular in the Indian financial system as an important segment of the financial market. And there are many types of mutual funds, already all of you might have known that is a growth fund, that is a income fund, that is a balanced fund. It depends upon the different kind of combination of the assets what the mutual funds have. Then we can also divide the mutual funds in open ended fund and the closed ended fund. The closed ended funds cannot be redeemed without maturity, but the open ended funds can be redeemed at any point of time, and the closed ended funds are basically traded in the market, what the open ended funds are not. So, these are the different differences between these. The exchange traded funds behave like a index which is tracking a mutual funds and trade all day in the stock exchanges, but in the hedge fund it is a private investment partnership whose shares are offered primarily to all the individuals, just now what I was sharing with you, and the major institutions often make high stake bets on the direction the market will take and supplying for the venture capitalist. So, hedge funds investment is a relatively riskier than the investment what we make in the mutual fund case. So, this is what the kind of another product services what the commercial banks can provide to maximize the revenue and as well as to satisfy the customers' requirements. Then we have the annuity investment products. These are the products which are used hedge against living too long, which provides a regular flow of income for indefinite period of time and outlasting one's savings basically. Then fixed annuity promises a customer who contributes a lump sum of savings a fixed rate of return over a life on the annuity contract. The fixed rate up to the whole lifetime, up to indefinite period of time, this particular cash flow will be available. A lump sum amount will be deposited in the beginning, and that will carry out certain kind of return over a long period of time. But the variable annuities basically allows the investors to invest a lump sum money in the basket of the stocks, mutual funds and other investments under a tax deferred agreement, but there may be no promise of the guaranteed rate of return. So, in case of fixed annuity, there is a guaranteed rate of return which is fixed from the beginning, but in terms of the variable annuities there is no guarantee, and the money which is deposited against that can be invested in any of the financial assets which are traded in the market. So, that is basically called the variable annuities fund. So, recently a new type of annuity contract has appeared, that is the equity index annuity, that is in US. It combines both the features of both fixed and variable annuities. One advantage of the financial firm selling this service is that annuities often carry substantial annual fees. That is why the commercial banks can do this business. But one significant disadvantage is that with annuities sold through depository institutions is that typically compete with the other selling deposits. So, that product itself is a competitor of another product. So, because of that it has certain kind of disadvantage with respect to the depository institutions which exist in the system. Then we have another kind of instrument what we use, that is called banca insurance. That means, the banks are basically selling the insurance product. So, how basically they do it? They can do it with a collaboration with an insurance company, where the bank basically undertakes the corporate agency to sell this insurance product to its customers, and they charge some fees against that. And why it is developed? It is developed because everybody has the idea the bank has a direct access to the customer, and the customer base of the banks is larger. So, because of that, selling this insurance product to the different customers through the banks is relatively easier, and against that the bank can generate some revenue out of this. There are different models through which this particular product works. One is referral model. The bank can refer a particular insurance product to the customer to buy by highlighting certain benefits of that, or they can directly act as a corporate agency that with certain kind of fees, then accordingly they can sell that product through them, or they can have a joint venture with the insurance company and develop certain kind of product. In India, which is popularly used by the different banks, where the bank insurance products are basically used in the context of a joint venture company, where the products is designed in such a way which are mostly is fulfilling the criteria for the insurance product what sold by the commercial banks. So, there are classification of the product in terms of the bank insurance, that is a standalone insurance product, and also there are some products which are available which is a combination of the insurance product and the bank products. So, this is the way basically the another kind of balance sheet activities the commercial banks can carry out, and through that they are able to generate certain kind of extra revenue. So, in this session what we have discussed, there are many off balance sheet items. We have loan sales, acceptance, participation, investment banking, mutual fund, insurance, all kinds of things also provided by the banks, and because they are not the regular flow of income what they get, that can be considered as the off balance sheet items in this, and through this the bank is able to manage the whole banking activity, and as well as it has the implications on the balance sheet. And all these activities also help the bank to diversify the risk and increase the income overall income of the commercial bank. So, this is the way basically the balance sheet items really play the significant role for the commercial banks, and in terms of maintaining the liquidity and as well as the profitability. These are the references what you can go through for this particular session. Thank you.